Focusing on long-term value. In this video, I want to talk about three things. Why focus on long-term value, how to measure long-term value, and how to increase long-term value. First, why focus on long-term value? Because operations must create value, and they create value to three different stakeholder groups: customers, shareholders, and employees. But as you can notice from here, the building blocks of operations subjected to external variables while creating value to customers, shareholders, and employees. Shareholder value is also created via customer value and employee value. Now, what is customer value and what is employee value? Customers value things such as better quality, desired level of variety, timely deliveries, competitive price, etc. Whereas employees value safe work environment, clear job description, stability and growth, respect and trust. Now, as we have talked about that, customer value and employee value actually contribute to the shareholder value, in addition to the shareholder value being directly generated by the operation. So they're all linked together. Now, if you focus on short-term shareholder value, that is only to milk the profits, not paying attention to customer value, not paying attention to the employee value, and not reinvesting in the business, that will result in a situation like the one that is shown here on the top of the chart. Whereas in the bottom you have a long-term shareholder value, which means the returns to the shareholders continue to increase. Okay, because you pay attention to the customers and employees and reinvest in your business. How do we measure long-term value? Right, so this is a long-term value formula. Value is essentially coming out from free cash flows that the investors receive, subjected to a cost of capital. And free cash flow itself is dependent upon the return on the invested capital and revenue growth. And this is the formula, a textbook formula, nevertheless a very robust and good formula that can be used to make decisions within organizations. Now, long-term value can be defined as the sum of all discounted free cash flows the investors are expected to receive in the future. But what do we mean by all these terms? What is free cash flow? So free cash flow is essentially NOPLAT minus investment. That is net operating profit less adjusted taxes. And what does it mean? We will talk about that. But NOPLAT is roughly like revenue minus cost minus taxes. And what it means is that it is like profit after tax. Let's simplify it at least here. Now, what we are saying is the free cash flows that are available to the investors, right, is not the entire NOPLAT, but a portion of it. That means the retained portion is essentially the investment into the business, which is used to increase the revenue, cut down the costs, probably restructure the taxes, and reduce the working capital, make investments for growth and cost reduction, which is the same, etc. So essentially what we do is use these reinvestments to increase the NOPLAT the next year, while of course paying attention to the customer value and employee value. So when all these things are aligned together, we get an year after year increase in the NOPLAT, which means an year after year increase in the free cash flows available to the investors. Just a bit of a definition on NOPLAT. So NOPLAT, while it is similar to the profit after tax, it's slightly different. So first of all, NOPLAT represents the after tax operating income generated by the company's invested capital available to all financial investors, excluding gains from non-operating assets. So the point is, we need to consider the operating income, and we need to consider all the financial investors, which means shareholders and debt holders, and exclude the non-operating assets. So that is NOPLAT. And this is how you calculate the NOPLAT. Like it is different from the regular accountant's statement. In the regular accountant's statement, after the operating profit, you deduct the interest and then calculate the taxes. And what you get in the end is the profit after tax or net income. Whereas in case of NOPLAT, you do not deduct the interest, you calculate the taxes, directly on the operating profit, and what you get is no plat. That means we are considering interests into the equation. And the reason is because of the fact that debt holders are also investors. And I will come to that point. So look at this point now. So who are the investors? There are two types of investors, shareholders and debt holders. Shareholders get dividends, debt holders get interest. And the free cash flow includes dividends going to the shareholders and interest going to the debt holders. And this is exactly the reason why in the no plat calculation we have not considered, or rather we have not deducted interest and directly calculated the no plat after deducting the taxes. Okay, so if you want to calculate the shareholder value out of the total investor value, then you have to take the proportion of the money that you give as a dividend, and the remaining, of course, is the interest. So we talked about free cash flows and investors. Now, what does it mean by discounted? What are you discounting? So all the future free cash flows are discounted and brought to the current year. That's what discounted means. So how do you discount? By applying a discounting factor, a 10% or 7 or 8% or something like that, which is representative of interest rate, for example. So £100, which I expect to receive 2 years down the line, is not equal to £100 today. So it may be more. So that's the point. So how do you calculate this cost of capital? So cost of capital is essentially cost of equity and cost of debt taken together and weighted average. So I don't want to go into the equation. If you may pause the video and check it out, but it is essentially a weighted average cost of capital, considering the fact that you may have different costs of equity and different costs of debt. Okay. Right, so the long-term value of operations is essentially the sum of all discounted free cash flows the investors are expected to receive in the future. And this is the formula that we talked about, basically captures the entire essence of what we are saying here. So that brings us to the last question: how to increase long-term value. So how do we increase the long-term value? You can use this formula to actually apply the concepts to increase the long-term value. If you try to increase the return on invested capital, you'll increase the value. If you increase the revenue growth, you'll increase the value. If you cut down the cost of capital, of course, you will increase the value. There is a caveat though. If you try to grow the revenue while the return on invested capital ROIC is less than the cost of capital, WACC, then you will drain the value. Ensure that ROIC is always greater than WACC. Otherwise, growing the operations, growing the business will drain the value. Or even if you grow a particular product line or a business within the larger business, that will also drain the value. How do we increase the ROIC? The best way to do is actually to construct a ROIC tree and link it to the operations. You can do that. You can do that very well. You can do it on a spreadsheet, or you can use a tool that I use. But essentially, you need to calculate various KPIs, operational KPIs, link them up to the whole financial and operational parameters of your operations, down to the level of ROIC, up to the level of ROIC at the high level, and down to the level of operational KPIs in the bottom. And you can find out which KPIs, which decision points, which parameters will drive your ROIC, and you can find out a to-be solution based on this, and then carry out that transformation within your operations. You could also increase the revenue growth rate, for example, which means that you could increase by average price increase or volume increase. Price increase, of course, has its limitations. Beyond a point, price increase will put the volume down, bring the volume down, demand, that is. Right. So how do you increase the volume for revenue growth? So you do both these things. You increase the demand generation, that is your sales effectiveness and the pipeline conversion, and also create capacity. Create capacity doesn't necessarily always mean that you have to invest in the capacity. You can actually create efficiencies within your operations to free up lost capacity because of high working capital or high work in progress, if you apply lean methods and theory of constraints or Lean Six Sigma, you will be able to identify areas or pockets of capacity, and you free up the capacity that could be used to increase the volume, and that will contribute to your revenue growth. So that's about the long-term value. Thank you very much.